If you've been collecting dividend checks from your investments and feeling pretty good about yourself, I've got some uncomfortable news for you. The dividend strategy that worked in 2010, it's basically a financial dinosaur in 2026. And yeah, I know that probably stings a little, especially if you've spent years building a dividend portfolio thinking this was the smart, safe way to generate passive income. You did everything you were supposed to do, right? You read the books. You listened to the financial advisors. You built a diversified portfolio of dividend-paying stocks. You set up automatic dividend reinvestment. You told yourself you were being smart and conservative while everyone else was chasing meme stocks and cryptocurrency nonsense. But here's the thing, nobody in the financial world really wants to tell you about dividend investing. The entire premise is outdated, and the tax consequences are way worse than most people realize. And if you're under 45 and building wealth in a taxable account, this mistake is costing you far more than you think. In fact, the wealth gap between someone who followed a dividend strategy and someone who took a completely different approach has become absolutely staggering over the past 15 years. My name is Ian, and I spend way too much time analyzing the strategies wealthy people actually use versus the strategies that get marketed to regular people. And dividend investing is the perfect example of how the financial industry sells you something that feels sophisticated and secure, while quietly steering you away from the tactics that actually build generational wealth. They make dividend investing sound boring and prudent. And to be fair, it is. What they don't mention is that boring and prudent also happens to be one of the worst possible ways to build wealth in the current economic environment. If you're tired of watching your dividend yields get destroyed by inflation and taxes, and you want to understand what actually works in 2026, stick with me. And if this already feels a little uncomfortable, that's a good sign, because the rest of this matters even more. So subscribe and hit the like button. This information can save you hundreds of thousands of dollars over your lifetime. The strategies I'm about to walk you through aren't get-rich-quick nonsense. They're what sophisticated investors have quietly shifted toward while dividend-focused investors are still waiting for their quarterly checks. The biggest problem with traditional dividend strategies sounds simple once you see it, but it completely changes how you should be thinking about your portfolio. Most dividend investors get obsessed with yield. They see a stock paying 5% or 6% annually and think they've found the holy grail of passive income. And I get why. It feels tangible. It feels real. But what they don't realize is that dividend payments create a taxable event every single year in a taxable account, and the tax rate depends on the type of dividend. Before we go any further, I want you to hear this not as tax theory, but as money quietly leaving your future. Some dividends are qualified and may be taxed at long-term capital gains rates, while others are taxed at ordinary income rates, especially things like many REIT distributions and certain non-qualified dividends. And for higher income investors, there can also be a net investment income tax layered on top. So that 6% yield you're excited about, after taxes, it can be meaningfully lower, depending on what you hold, what account it's in, and where you live. And if you live in California or New York, state taxes can drag it down even more. When you actually sit down and run the numbers, the math gets brutal fast. You thought you had $6,000 in annual income from your $100,000 portfolio, but your real after-tax income can be thousands less, depending on your bracket and the dividend type. That's not passive income. That's feeding a tax drag every single year while telling yourself you're building wealth. And here's where it gets really problematic. If your after-tax yield is only a few percent, inflation can eat most of it. The exact inflation number changes year to year, but the outcome doesn't. If your yield gets chopped down by taxes, your real return can end up dangerously close to zero. You're generating income, paying taxes on it, and then watching your purchasing power erode while feeling like you're winning, because a dividend check shows up every quarter. That's psychological warfare. The financial industry wants you focused on how dividends feel, so you don't notice that your real wealth isn't actually growing. This is the dividend trap. Investors fixate on yield instead of total return. They collect income while losing ground on growth. They win at the feeling of success while losing the game of actual wealth building. Meanwhile, someone else owns companies that pay little or no dividends and quietly compounds with less forced taxable income along the way. And this is important to understand because once you see this pattern, you start noticing it everywhere. The financial media doesn't talk about it because it doesn't fit the narrative they've been selling for decades. The second problem with traditional dividend strategies is even more insidious. And this is where most people really get fooled. When companies pay dividends, they're sending cash to shareholders instead of reinvesting it back into the business or using other capital return tools like buybacks. Sometimes that's appropriate for mature companies, but in a world where innovation and competition move fast, there's a real opportunity cost. Cash paid out as dividends can't be used for research and development, expanding market share, or strengthening the business. Historically, a massive portion of wealth creation has come from companies whose returns were driven primarily by earnings growth and price appreciation rather than high payouts. Berkshire Hathaway has been famously anti-dividend for decades. Apple went years without paying a dividend while becoming one of the most valuable companies in the world. Amazon never paid a dividend while building massive scale. Microsoft, Google, Tesla, Nvidia, notice the pattern here. These companies made people wealthy primarily through long-term growth and, in many cases, buybacks, not income checks. Yet the financial system keeps nudging you toward dividend stocks while so much of the wealth creation has been happening elsewhere. Companies confident enough to reinvest heavily are often the ones with the most explosive long-term upside. Dividend investors, meanwhile, tend to chase mature businesses, and in many cases, they don't realize they're getting left behind until it's too late. The tax situation is even worse than most people think, and when you actually run the numbers, the difference becomes shocking. Let me walk you through it because this is where the gaps really opens up. Say you have $100,000 invested in a dividend portfolio yielding 5%. That's $5,000 per year in taxable income in a taxable account. Depending on whether those dividends are qualified and whether additional investment taxes apply, you're paying taxes every single year. Do that for 30 years, and you can easily hand over tens of thousands of dollars in taxes along the way before you even think about selling. And when you finally do sell, you may still owe capital gains taxes on appreciation. You've paid taxes annually and again at liquidation. That tax drag matters because it reduces how much money is compounding inside your portfolio. Now compare that to a strategy that produces more return through price, appreciation, and less through taxable distributions. Historically, broad United States equity markets have delivered returns around 10% annually over the long run. And here's the key difference. You don't owe taxes on unrealized gains each year. You generally owe taxes when you sell. That deferral is incredibly powerful. After 30 years at 10%, $100,000 grows to roughly $1.7 million before taxes. Yes, you'll owe capital gains when you sell, but you also had decades of uninterrupted compounding. That's the power of tax deferral. And this is before we even talk about how dividend-heavy portfolios often tilt toward mature sectors, while lower dividend strategies capture higher growth parts of the economy. You're choosing slower growth with ongoing taxation over faster growth with flexibility. Once you see this, it's hard to unsee. So, if traditional dividend strategies are basically financial quicksand, what actually works in 2026? This is where things start to flip. The wealthy have quietly shifted towards several smarter approaches, and understanding them changes how you think about investing going forward. These aren't complicated strategies. They don't require special access or exotic products. They just work better in the current environment. The first strategy is buying dividend growth stocks instead of high-yield dividend stocks. This sounds subtle, but it's critical. Instead of chasing yield, you look for companies that consistently raise their dividends. A company paying 2% today that raises dividends 10% annually can eventually outperform a flat 6% payer, especially if earnings and the stock price grow alongside it. You're not buying a yield, you're buying a business that can grow. Companies like Procter and Gamble, Johnson and Johnson, Coca-Cola, and McDonald's aren't exciting, but they've historically created real wealth through dividend growth and appreciation. And here's the part people underestimate. The psychological advantage matters too. Instead of chasing yield and getting trapped in low-quality companies, you're owning quality businesses that happen to reward shareholders. The second strategy that's working is using REITs strategically instead of relying solely on individual dividend stocks. REITs are different, and this is where nuance matters. They're legally required to distribute most of their taxable income, which can create genuinely high yields. Their tax treatment is different, and you need to understand it, but they also provide diversification into real assets without becoming a landlord. You get exposure to apartments, office buildings, warehouses, data centers, and other real estate sectors without dealing with tenants, maintenance, or management headaches. Used correctly, REITs can play a role traditional dividend stocks simply can't, especially when income and diversification actually matter. The third and most underrated strategy is covered calls. This is where many retail investors get nervous and most people stop paying attention, which is exactly why it matters. If you own 100 shares of a quality company, you can sell call options and get paid immediately. The tax treatment is nuanced and not automatically better than dividends, but when done correctly, covered calls can be a legitimate way to generate cash flow. You're getting paid to sell the right for someone else to buy your stock at a higher price. If the stock gets called away, you made money on appreciation plus the premium. If it doesn't, you keep the premium and the shares and can do it again. It's income with optionality, and it's something sophisticated investors have used quietly for decades. The fourth strategy is building a barbell portfolio. On one side, you own extremely safe income like treasury bonds or high-yield savings. A treasury paying 5% is fundamentally different from a dividend stock paying 5%. Treasury interest has different tax characteristics and no company-specific risk. On the other side of the barbell, you own high-growth stocks that may pay no dividends but have massive upside. This gives you income and growth without forcing you into mediocre stocks just to chase yield. You get real income from bonds and real upside from equities, with more control over tax timing and less pressure to make bad compromises. The fifth strategy is the most radical and the most effective. It's abandoning the idea of living off investment income and focusing instead on total return. This is where the mindset really shifts. Wealthy investors let assets compound for decades and only later sell strategically to generate cash flow. That gives you control over timing, taxes, and flexibility. You stop thinking like an income investor and start thinking like a wealth builder. Once that shift happens, everything else starts to make sense. The reality of dividend investing in 2026 is simple. Interest rates have normalized. Tax efficiency matters more than ever. And high yields often signal risk, not opportunity. Yet financial advisors still push dividend portfolios like it's 1995 because they're easy to explain, easy to market, and generate consistent fees. But the market has changed and the strategies need to change with it. If you want real wealth in this environment, you need to stop obsessing over dividend yield and start focusing on total return, tax efficiency, and growth. The bridge worked once. It doesn't anymore. And the smart investors have already moved on.